Thus far we've looked at momentum and value investing, but there are a range of other factors that can be used by investors that align with various different investment philosophies in terms of how investors view markets working. In this learning objective, we're going to look at both the low volatility and the quality smart beta factors, both of which are often used in conjunction with value investing. Low volatility first of all. While the CAPM assumes that investors can borrow and invest at the risk-free rate, we know that in practice the cost of borrowing is much higher than the interest rate that you can receive on any investment. So what this means is that while the capital allocation line in theory is a straight line, in practice it is a kinked line. And if that line is kinked, what we might actually find is that in lieu of leverage, investors may actually have a preference to invest in risky assets rather than investing in the optimal risky portfolio and levering up along the capital allocation line. So what we might find is that there is an over-demand for high volatility stocks because of this issue around the preference for high-risk assets because of the inability or the difficulty to leverage up with the optimal risky portfolio. And that pushes the price of high volatility stocks up relative to their fundamental value. And the flip side is the price of low volatility stocks is lower, and hence the expected return of low volatility stocks is higher compared with high volatility stocks. So there is a smart beta factor whereby investors look at low volatility by saying that because of these mechanics of the market, because of this potential preference for high volatility risky assets given some of the limitations on the theory which suggests you can just always invest in the optimal risky portfolio and leverage, there may be a world in which low volatility investing can achieve higher returns and investors seek to exploit this. There's a range of different ways that investors can try to come up with low volatility strategies, but let's have a look at a few different approaches that are often used. Basically what we've got here are the abnormal returns, so the returns on various different low volatility strategies compared with the market returns across a 50 or so year period from 1967 through to 2011. So the four different strategies we look at here. From left to right, so the S&P low volatility stocks, that's just looking at stocks within the market that on average have lower volatility and are screening to hold those particular stocks in your portfolio. And we can see that that particular portfolio tends to, or that particular index, tends to outperform the overall market index by about 1.59%. A couple of other strategies are looking at weighting stocks according to the inverse of their measures of risk. So the one-on beta approach is whereby you look at weighting stocks according to the inverse of its beta. So if you've got a high beta stock, a high risk stock, the inverse of beta will mean it will have a very low weighting, whereas low beta stocks will have a very high weighting. And that particular approach also generates positive abnormal returns of about 1.73%. Similarly, you can look at risk as being the volatility or standard deviation of returns. And in this approach, you take the inverse of the standard deviation of returns and use that as a mechanism for weighting stocks. Therefore, low volatility stocks have higher weightings, high volatility stocks have lower weightings. The last approach is to look at the optimization calculations that we've previously looked at in lectures and come up with a simulated minimum variance portfolio. And often what you'll do is use the historic covariance matrix in order to identify that particular portfolio and hold that minimum variance portfolio instead of holding the optimal risky portfolio. And evidence suggests that holding the minimum variance portfolio also outperforms the market. As well as looking at low volatility factors, another suite of different alternative smart beta factors that investors may decide to exploit as part of their investment philosophy are several factors relating to firm quality. So Astis, Franzini and Peterson 2014 argue that investors do not fully incorporate firm quality into prices. They don't fully recognize the importance and the value of firm quality, resulting in high quality firms being underpriced and subsequently generating positive abnormal returns. But the problem with quality is it's a nebulous concept. It's not something that's clearly defined. So what we have to do is come up with a measure by which we can identify the quality of a firm. And a range of different measures of firm quality have been proposed. These include asset growth, accruals, net share issuance, profitability, and corporate governance. So let's have a quick look at each of these measures and the evidence related to them. Asset growth, first of all. The idea behind asset growth is that there's been several studies that have identified that firms that grow at an extremely fast rate, firms that have high growth from one year to another, tend to subsequently have negative returns. The argument here is that corporate events associated with asset expansion might be related to issues around misuse of funds by managers or corporate events that can be detrimental to a firm, such as large amounts of leverage, etc. Therefore, the argument is that higher quality firms are those that grow at a slower rate. So you should not invest in firms with extreme growth from time to time. Consistent with this argument, Cooper, Gullen and Schill demonstrate a strong negative relationship between asset growth and subsequent returns, and this association is confirmed by Gray and Johnson in the Australian market. So starting with what Cooper, Gullen and Schill showed, they rank portfolios based on past asset growth over the previous year and hold that portfolio for the next year, rebalancing annually. And what we can see here is there's evidence that the low growth portfolios earn quite high positive returns and the high asset growth portfolios earn low returns. So it appears one way to measure firm quality is those firms that have low growth of assets from year to year. Another indication of firm quality might be accounting accruals. So the idea of accounting accruals is based on the accrual accounting system, whereby revenues and expenses are recognised on the balance sheet as soon as they're incurred, as opposed to when the cash flow takes place. Therefore, at the end of every year, the accounting profit that's recorded is a combination of the net cash flows, or the cash flows that come in and out of the business, plus the net accrual balance. And the accruals are revenues that are recognised before cash flows come in. So, for example, you would recognise a revenue when an invoice is drawn as opposed to when an invoice is paid. And also the recognition of expenses that might be either incurred early or delayed. So with an expense, for example, if you were to incur an expense but not have to pay it until the future, you should recognise that expense when it's incurred. Now, the argument around accounting accruals is that if you decompose total profit into the net cash flow and accrual components, the net cash flow is more informative of actual economic performance, whereas the accruals component of profit is able to be potentially manipulated by the firms and accountants, etc. So the idea of accounting accruals is that those firms who report net profit figures where a larger proportion of that profit is through accruals rather than cash flows should subsequently underperform, whereas those firms whose profits are largely made up of net cash flows and a smaller proportion of accruals should perform better. Consistent with this evidence, research has shown that if you form portfolios based on the accrual balance at the end of the financial year and hold those portfolios for another year, we see from 1 through to 10, 1 are firms with low accrual balances and 10 are firms with high net accruals. And we can see those firms that have low net accruals earn positive abnormal returns, those with low net accruals, high positive abnormal returns, high net accruals, negative abnormal returns. So there appears to be evidence of a relationship between accounting accruals and subsequent returns. Another measure of quality, net share issuance. So there's a range of studies that basically argue that firms might time the market. That is, they'll issue shares where they perceive their current market share price to be overpriced, and they'll buy back shares where they perceive that their current market price is underpriced. Therefore, the argument here is an investment strategy where you would buy stocks that engage in buybacks and you would sell stocks that issue new shares. So when we look at the evidence regarding this, we can see on the screen here evidence from the Australian market from 1988 through to 2012, where there's 3 portfolios. So at the start of every year, all firms are put into one of 3 bins, either those that don't issue any shares or have buybacks, those that have low share issuance, and those that have high share issuance. And what we can see as the net issuance of shares, the secondary, the new shares issued through either rights issues or secondary public offerings or private placements, etc. As those increase, we tend to find that subsequent returns in the following year decrease. So consistent with the theory that maybe firms are timing the market, the idea is that when firms issue new shares, they subsequently tend to perform poorly. The last quality screen that might be considered is to look at measures of firm quality by focusing on the management of the firm. And in particular, what we look at here are the internal corporate governance characteristics. So agency theory suggests that potential costs can be incurred due to the separation of ownership and management, whereby when there's good corporate governance practices in place, these costs can be mitigated. Therefore, firms that have poor corporate governance, you might expect there are higher agency costs and hence poor subsequent return performance, whereas firms with strong corporate governance should arguably perform better in the market. Consistent with this theory, there's empirical evidence that shows there is a relationship between corporate governance and subsequent returns, and we can see that on the screen here. So forming portfolios at the start of every year by ranking stocks according to a range of different governance characteristics, holding those portfolios for the following 12 months, and then rebalancing every year, we can see that those firms that have strong corporate governance tend to earn an average annual return of about 11.5%, whereas those stocks with poor corporate governance earn an average annual return of only around 4%. So as corporate governance improves, so too does subsequent return performance on average. Just to sum up in terms of looking at low volatility or quality, we know that we've seen before value investing simply seeks to identify cheap stocks. So it's basically coming up with some measure of fundamental value of the firm and comparing that to the market price. However, studies have argued that just identifying cheap stocks is not enough. What you might want to do is to combine value with some of these other factors. So maybe combining value with low volatility or quality. And in fact, Asness, Franzini and Peterson report that combining quality and value together, which they call quality at a reasonable price, results in positive alpha that's higher than either value or quality investment strategies alone. So consistent with this idea as well of combining value with other factors, Standard & Poor's have actually introduced the S&P GIVI index. And basically this is a rules-based index that combines low volatility investing with value investing. And furthermore, Asness, Moskowitz and Peterson argued that there might be merit to combining value and momentum together, given the high abnormal returns that are generated by both these investment strategies, and the fact that these two strategies tend to be negatively correlated with each other. Hence, there could well be diversification benefits by having these two investment strategies together. So, in short, while there is strong evidence in favour of value investment and its efficacy, and a strong amount of academic evidence that reports the abnormal returns that are generated by value investment strategies, potentially an optimal investment strategy can involve not only value of itself, but combining value with other factors such as quality, low volatility, or momentum.